Welcome everyone to this Thursday's 5 at 5 for Minds and Money. We've been running this since April now, and what a fantastic, online initiative that this has been. On the back of this initiative, we've obviously, over the last 3 days, run our Minds and Money online APAC event, which obviously some of you have heard about or have been a part of already for the last 3 days. We've had 4 to 5 hours of content over each day. We've actually got some stats with about 300 live attendees per sessions and an average of about 70 per chat room, which was fantastic. We've had about 500 meetings conducted over 3 days as well. So these are one-to-one business meetings that were able to take place. And obviously with speakers, we've partnered with the Queensland Government, who have been a great support of the event online. And we've heard from their ministers, as well as the federal minister, Nev Power, a bunch of mining CEOs, including people like Fletcher, who we'll hear from later on today, as well as industry executives who we've also had online. So overall, it's been a great success with all these online initiatives. There's obviously technical difficulties at times, but we've pushed through and come on the other side. And obviously this 5 at 5 is where it all began. So I'm really glad to welcome you all here today. I'd like to obviously thank the Brisbane Mining Club, Andrew Vigar and his team, Simone, for helping work with us on some of the speakers that you'll see over the next 45 minutes. And obviously their support for inviting their members to come along for the first time for today's episode. But always, our series partner for the event is the Melbourne Mining Club, and we obviously thank them too. Without further ado, obviously just want to remind everyone, you're all on mute at the moment. But during Q&A time, if you do decide that you'd like to ask our speakers a question, please do pop that into the group chat, and then I'll be able to unmute you during the Q&A time to be able to ask that question to that designated speaker. But for now, you're on mute. Please put your cameras on. We love to see your smiling faces and also see your background. I see Ivan there. I think he looks like he's having a beer. Very jealous of that at this particular time. But yeah, look, do engage with us because that's what this is all about. Andrew, I'll pass on to you from the Brisbane Mining Club.
Thanks very much, Sherene. And I guess this the Brisbane Mining Club involvement really came out of the COVID-19 and what's been going on, and that we've always been about holding networking events as a club and supporting the industry and everybody who's involved in it, not just the miners, but the lawyers and accountants and everybody else involved and suppliers. And the thought of having an online session really came out of that. And we've been strong supporters of Minds and Money and partners with them for many years. So this session has sort of arrived out of that over the last couple of months. So thanks very much to Minds and Money and Sherene for organising all this. We've been going about the same time, over 10 years now. And really the changes that are happening within COVID-19, in our view, are really accelerating what was already happening. I mean, it's been pretty dramatic and it's been pretty sudden, but these changes in remote networking and even remote work were already underway. So it's just really turning into a harder reality. We're all coming in from different parts of the world. As I said, I'm in Northern New South Wales at the moment. Borders closed. COVID-19, we see it every day. Very tough getting back and forward at the moment. We've got an excellent panel for the discussion. We've got a banker, a lawyer, a miner and an explorer. So that's not a joke. I think I should follow that with a punchline somehow or other, but it really turned out really nicely that we've got a good blend of people. So everybody out there, it is meant to be a chat. It's meant to be an informal 5 p.m. with your cup of tea, as we shall call it. You can have whatever you like in the cup, but as long as it's a cup of tea, then please join the conversation. As Sherene said, if you want to ask a question at the end, please do so at the end of each speaker, but we've already had some questions. We've had about a dozen come through already, and our speakers have been briefed on those. So I think I'll kick off. Mark, you ready?
Yeah, Andrew.
Yep. Okay. I'd like to introduce Mark, who's our first speaker today. Mark's a banker with the ANZ, Director of Natural Resources based in Brisbane. He has had a very strong background both in Europe and Australia in banking, and particularly as in PNG as well. He's going to be discussing market trends in finance and capital raising, both pre and post-COVID, and then we'll have a bit of a chat afterwards. Over to you, Mark.
Thanks, Andrew. Yeah, I guess just to give everyone a bit of a sense in terms of what's transpired, upon the outset of COVID in the bank market. What we saw certainly early on in February, March, and also April was a wave of requests from borrowers across all industries, whether it's the diversified side, mining, oil and gas, to shore up balance sheets, and essentially the banks look to support those clients by providing liquidity facilities. So very early on, it became apparent that, and we saw this during the GFC, was a concern around liquidity, but that concern certainly went away very quickly when central bank like the Reserve Bank of Australia pump huge amounts of liquidity into the banking system, and we've seen other governments around the world as well do the same. So whilst the liquidity situation abated, I guess in terms of the call on banks' balance sheets to provide these liquidity facilities, it then became an apparent issue around banks' capital, and you obviously saw various banks taking various moves to shore up their own balance sheet, whether it was ourselves, ANZ, deferring our interim dividend, or the NAB looking to go out and actually raise capital. In term, and I guess the other issue around capital is that banks have had to hold increasing amounts of capital because of the deterioration in their loan book, as COVID has unfolded over the past months. So what we've seen is obviously cost of capital increasing, and to give people a bit of an appreciation in terms of the investment grade space, 5-year tenor, we're seeing margins increase in the vicinity of 60 to 70 basis points from pre to post COVID. So Andrew, did you?
Yeah, we've got if you wanted, we've got one question here from the audience, and then I guess we might open it up to somebody else, Sherene, who might want to ask a question. We had a question come through about political and country risk, particularly in developing countries, and whether this had been changed with COVID. What's your view on that, Mark?
Yeah, I think obviously companies have a criteria that they go through in terms of which project to develop, whether it's cash costs, political, country risk, and the reality is that companies will invest where their capital is welcome, first and foremost. And I guess if you look at a number of the major mining houses and oil and gas players, for that matter, they have a portfolio of assets at varying stages, whether it's in production, in development, pre-development, feasibility, etc. So they will certainly look at political or country risk considerations, such as potential changes to mining acts, etc., in terms of where they choose to invest their funds and progress their projects.
Have you seen anything yourself, though, Mark, recently that's been that's changed, or that any countries that have moved significantly?
Yeah, I think there's varying forms of political risk. Obviously, there's the disruption that you saw in various countries in South America earlier in the year, and I know in this part of the world there's a big spotlight on the various changes that PNG as a country are looking to embark on in terms of changes to their Mining Act and Petroleum Act. But the reality is that we're likely to see projects delayed significantly.
Yeah, because there's been quite a bit in the press recently with what's happening at Porgera.
Yeah,
the question
indeed.
that's come through here to you, Mark, from Paul Robertson, saying in Europe and US, we're seeing high yield debt markets reopen in metals and mining. Who is open to fund non-IG in Australia right now? Any comment on that?
Yeah, so the bank market is selectively looking at non-investment grade credits. We'll evaluate each and every one of those on their own merits. So the bank market is still open, and I guess Paul's raised another good point was pre or at the start of COVID, we saw the bond markets very much shut for business. And over the last month and a bit, we've seen those bond markets reopen, and the reality is bond investors still have a lot of liquidity and cash in which they're willing to invest. It's just the pricing on those issuances are significantly higher than what they were come the end of last year.
Okay.
Are they mainly focusing on the first world countries, Mark, or pretty much anywhere?
Look, I mean, the bond markets historically are focused on investment grade and sovereign. But Paul does make a good point in terms of those high yield bond markets selectively looking for opportunities to invest.
One quick question here also from Dahl is how do you see the market how do you see the market for traditional forms of financing of advanced stage met coal projects in current climate? I think quite relevant to Queensland. So met coal projects in the current climate. Mark?
Yeah, so I think what you're going to see, hopefully come the end of this year, early next year, is that bank markets will hopefully return to some form of normality. The reality is that there are a number of projects in the metallurgical coal space that are approaching the market as we speak. I think what people are going to have to consider is other forms of liquidity and funding outside of the traditional bank market, and whether that's from export credit agencies, from NAIF, North Australian Infrastructure Fund, EFA, etc., to see these projects get up. And I guess the other point that export credit agencies provide is that they provide significant tenor. So whereas now banks are pulling back in terms of tenoring, the bank market is beyond a 5-year tenor. It's pretty much closed. That's the maximum tenor that banks are willing to lend to at the moment.
Okay, we might move on to Aaron. Andrew?
Yeah, I think so. Next panelist for today is Aaron, a partner at McCullough Robertson, another supporter of the Brisbane Mining Club, corporate advisor in mergers and acquisitions, capital raising, board duties, discussing market trends related to regulation and the law, particularly ASIC, ASX and FIRB. Lots of letters there. Over to you, Aaron.
Thanks, Andrew. Yeah, look, I'll be quick. I think just sort of following on from Mark's observations, when COVID started, as lawyers, what we were seeing was what you'd expect, which is a lot of queries around force majeure for projects, a lot of queries around how, what's going on with my M&A deal, is there a material adverse change here? What do we need to do to progress transactions? So that was sort of the reaction at first. In more recent times, we've seen both the ASX and ASIC, so basically the market regulators for equity raising, try to encourage equity raising by changing the rules, and in particular, changing the rules in relation to secondary capital raising on the ASX. So what they did was come out and said to basically to everyone, they upped the limits on how much capital you could raise from 15 to 25% for placements. And they also changed the rules a little bit to make it somewhat easier for certain companies to do it. Given the uncertainty, they also allowed companies to do a back-to-back trading halt, so basically 4 days worth of trading halt instead of 2, which does help people find the time to sort of get 25% worth of capital and do it efficiently. And they also made a bunch of other changes. One of the things they required as part of that was that if you're going to go out and raise a big lick of capital and dilute shareholders, that you've got to also offer the same deal to your existing shareholder base. So basically, one of the things they required was a rights issue or a follow-on share purchase plan. So there has been a bit of that. Not as much probably in the resources energy space as they have in other sectors, but certainly we have seen a fair bit of capital being raised using that. The other change that affects capital markets is the change to the FIRB rules. So Treasury came out and essentially changed the thresholds that trigger a requirement to seek FIRB approval. It was up to, basically an exemption for transactions less than about $300 million. They've knocked that down to 0. For a lot of resource mining or energy companies that hold land tenements, it wasn't particularly relevant, but there would be some out there who previously didn't necessarily need to worry about FIRB, but now do. And Treasury said that it could take you up to 6 months to get FIRB approval, which is essentially knocking a couple of transactions that I've seen on the head. No one wants to wait that long or spend the money required to actually get the approval. And a couple of other things that we've sort of seen. The ASX, I think it's fair to say, is being quite cautious at the moment. So we've seen some real caution from them in relation to sort of backdoor listing transactions. So they seem to be taking an approach, quite a cautious approach to those type of deals. You used to be able to do those transactions with shareholder approval, for example. We're seeing them sort of require prospectuses and disclosure documents and a lot more compliance than I think they may have done 12 months ago. Depends on the transaction, obviously, but we are seeing that. And the other thing is caution around the terms of convertible notes, particularly when they're highly dilutive. So they're looking quite carefully at that. They did change some of the rules and some of their guidance in relation to convertible notes, but I've seen them sort of scrutinise those quite heavily in a way that we probably hadn't seen before now. So, Andrew, that's sort of, I think, probably at a very high level what we're seeing from a legal point of view.
Yeah, no, good, mate. We did have a bit of a question come in on relating to IPOs and traditional, whether this was traditional space, but that's probably better a question left for Rob, I think. Rob, did you want to look at this? The question was traditional raising via an IPO was a traditional choice for operators sitting on large-scale deposits with reserves. Has the panel seen any change in the IPO space given recent events, and do you expect these to continue? I'm jumping the gun, Rob, but jump right in.
Yeah, look, if you've got a good project, that IPO is still viable. But what hasn't worked in the last 12 months are IPOs with very dubious geological prospectivity that have been put together with massive fee payouts to certain promoters, and these things have gone over like lead balloons. But projects that are well thought out, got some commercial potential, are fine. And the other ones that have worked quite well, of course, we've been very lucky in that we've had 5 or 6 significant metalliferous discoveries in the last 12 months, and anything pegged close to those have done well. There's been 2 recent IPOs on the Molong High down in New South Wales, near where Alkane have discovered Boda, and both of those are making money for their shareholders. I had one question though for Aaron. We've recently seen a lot of capital raisings, particularly from 2 or 3 broking firms in WA, that have come through at massive discounts to the share price, the VRAP. In the old days, when I used to run companies, it used to be maximum was 20%. What's the maximum now that people can discount shares in a capital raising?
It depends on the type of raise, Rob. So there is still a 20% limit for what's called a share purchase plan, although they have varied that in recent times. But essentially, you can do a placement at whatever discount you like.
Okay.
Yeah.
Yeah, that just seems to kill the shareholder. That's all, the old existing shareholder.
We've got a question for you, Aaron, from, he's just disappeared from my screen for a second. I hope I've unmuted Matt Gill. Matt, do you have a question for Aaron?
Hi, Aaron. Yeah, with my White Rock hat on, we just raised through a placement with a back-to-back share purchase plan, as you rightly described, and we used the 2-day plus 2-day, and I've done a few capital raisings, and it worked a treat. As you would normally know, you're going to trading halt, you do your soft book build, but you've either got to bring people over the wall or you've got to dance around the issue that it's a lead up to a raise. You take your 2 days, you normally back it into a weekend, so you get 4, but 2 of them are obviously a weekend. Getting 2 plus 2 business days around a weekend gave us time to have a proper conversation with investors, including some major shareholders, that were able to release the funds that they then need to commit in a placement, including from North America as well. My question is, do you know whether there's been a general comment like that back to the ASX, and whether there's some vehicle or business group that are asking whether the ASX will bake that into normal business going forward post-COVID?
Yeah, Matt, look, that's a really good point, and I agree, it is a lot better. Look, I'm not sure there's any general business group, but certainly we've given that feedback to them as part of some sort of more formal consultation processes that they do. But I think, it's for their clients to do that, Matt. At the end of the day, the ASX is also a business that's sort of got, a couple of thousand clients. And if those clients go back to them and say, hey, this is something that we want, and it may be that it's not sort of an automatic 4-day trading halt, but you go and have a chat to them and they might allow you to do it if that's necessary. Particularly for smaller companies, where if you don't have, brokers that have almost stitched it up beforehand, and you actually do need to go and, genuinely try and raise money, 2 business days isn't a long period of time to do that, as you say, and get the comfort that people are actually going to have the money when you come out of it ready to go. So, look, we've given them that feedback, and I think certainly the reason they did it is because there's been feedback from people that sort of suggests it is a little difficult unless you are, unless you are a sophisticated issuer with sophisticated brokers, it can be difficult to get a placement, particularly of that sort of size, away in 2 days. So I think that's why they did it. Let's hope that they allow us some more flexibility in the future.
Well, one more question for you here, Aaron. I've just unmuted steve@gmail. Do you want to ask your question, Steve?
And talk to Rob Murdoch's point about the promoter outcomes from IPOs. ASIC seems to be quite on top of that now. So I was wondering whether that's taken more of the dubious IPOs away. And one for Aaron too on the capital raises. ASX and ASIC are quite keen on scale back scenarios and policies. They seem to be quizzing companies up front quite a lot on that before the deal even hits the market. I was wondering whether you're seeing any of those allocation policies for the placement hurting the ability to get that away, and whether the time that you would take to market with the extra discussions with ASX stretching timetables out.
Yeah, okay. So the first question was just about the promoter outcomes. Look, I think the answer is yes, and it's ASX as well. So, you know, ASX just have a general discretion, Steve, to just say, we don't like your deal, or we don't like what you're doing. And it's more often than not, ASX are the first people that sort of get a sniff of the IPO. So as part of the process, you tend to go to ASX first, and then ASIC doesn't really know about it until you've got a prospectus up and ready. And the ASX have encouraged sort of a pre-lodgement consultation with them now. So you sort of go to them in advance. Yep. And I think that is the place where those sort of, you know, outrageous promoter issues are being knocked on the head. And it's not just in IPOs, Steve. It's M&A deals as well. We're seeing them sort of say, we just don't like it. We don't think it is consistent with, you know, the values of an ASX company, and therefore we're just not going to allow it. So yeah, I think yes is probably the short answer, but I think it's ASX as well as ASIC that's doing it.
Rob, second part.
Yeah, we are actually, that might be the reason. Thanks for that, Steve. It might be actually the reason we're seeing a lot less IPOs this year. The ones I was talking about with the heavy promoter presence were more in 2019. I just figured that we probably weren't seeing as many because of the COVID situation, but it could be that the clamping down has done that, Steve.
We might move on, Andrew. Oh, we lost Andrew. Okay, well, I'll step in here for Andrew. Thank you so much, Aaron, and the speakers. The next speaker is Brett Fletcher from Red River and Ravenswood Gold. Brett.
Fantastic. Thanks very much, and good afternoon to everybody. Look, I guess really from my point of view, just wanted to talk a little bit from the actual mining perspective about a couple of projects that I'm involved in at the moment, and some of the challenges and opportunities that we've seen over the last months and weeks. So from a day job, I'm the CEO and Managing Director of Ravenswood Gold. So we're actually a pretty new company. In fact, the company's really 3 or 4 months old. We've I guess have got pretty big parents though. So we're owned by a joint venture, which is 50% owned by EMR Capital. And I think most people would be familiar with EMR Capital, the private equity mining business based in Melbourne and Hong Kong. And we're actually their third operating asset in Queensland, and the 4th operating asset in Australia now. So certainly got a lot of support from EMR, and the other joint venture partner is a company called GEAR, or Gold Energy Resources, who are a Singaporean listed company with a very strong focus on mining of coal in Indonesia, and they've also recently taken control of the Stanmore coal operation here in Queensland as well. So I guess, you know, I'm not going to really be able to do justice to the project, I don't think, in 2 minutes. But, you know, really this is all about, you know, creating a completely new, large-scale, low-cost, modern, fundamentally long-life mine at Ravenswood. So those that might know a bit about Ravenswood actually started in about 1870. Had various owners through the years. You know, it's certainly developed some scale about it over, I guess, over the last, you know, 10 years or so, where it was a, you know, a key asset of Resolute. Resolute decided to sell the asset. EMR and Gear decided to get together to buy it, I guess, and push ahead with the expansion project, and hence the formation of Ravenswood Gold. So I guess what we're trying to do at the moment is, you know, we're taking the operation, you know, the next phase. So we're in the process now of recommencing open pit mining. So we're going out, or about to buy $120 million worth of mining equipment to recommence mining operations. We started on, I guess, the plant expansion. You can see the beautiful plant there in the background. We're taking that from, you know, 5 million up to 7, 8 million tonne per annum configuration. We're in the process of building a new tailings dam as well, so putting in a 100 million tonne tailing dam, 100 million tonnes worth of tailings dam at the moment. And I guess we're trying to do all of that with the COVID-19 running around in the background and working our way through various permitting and other type issues. So really, I guess the great story is that, you know, it's in Queensland, it's gold, and it's regional. And we're looking, I guess at this point in time, we're lucky to be in a position we're actually looking for people. So we're hoping to put on around about 200 permanent jobs over the next 12 months. And we think in the construction phase, probably about another 180 in that area as well. Obviously, we're targeting as much as we can, you know, to utilise local suppliers, contractors, trying to get all of our people from the local area, and by local area I mean Ravenswood, Charters Towers, Townsville, Home Hill, Bowen area, which is really where 95% of our people come from at the moment. So it's a great story. You know, we've had a lot of support from, you know, suppliers, the local community, you know, right behind us. You know, state government's been great. The Ravenswood project is a, you know, a gazetted project of state significance. So we've had the Coordinator General helping us, and the Coordinator General's department, which is, you know, invaluable really. And, you know, it's all steam ahead. So, yeah, thanks for that second slide. So, you know, really it is about, you know, we're trying to build a 200,000 ounce per annum operation, and hopefully somewhere around 250,000 ounces per annum. We've already got 2.7 million ounces of gold in our mining inventory. We're looking to, like I said, ramp that plant up as much as we can. We're investing heavily in exploration. You know, both of our, I guess our owners are keen that we explore, so we're about to start a program, both what I would say is near pit, near mine and regional, and we've got about 2,000 square kilometres of exploration tenements as well. So a huge piece of Queensland, all centred around Ravenswood, and we're tracking to, you know, to take that forward as quickly as we can. So exciting place to be, and like I said, we're getting a lot of support. So in otherwise what could be quite dreary times, it's good that you know, these sort of gold operations can, you know, find another phase of life, if you like, and we're hoping that that this asset will go for another 15 years. I'm also involved in Red River Resources. So primary asset is the Thalanga Base Metals Mine. I'm the chairman of Red River, bit of a different business. It's ASX listed. So we're on the exchange, set up almost as a startup. We bought an asset off the administrator for about $7 million about 3 or 4 years ago. Restarted that asset. We've got that up and running, employing about 200 odd people at the moment, operating predominantly out of Charters. And I guess going through all of the same sort of COVID-19 challenges and regulatory challenges and metal price challenges, but still exploring, still building more mines. We're about to embark on the construction of our third mine there, which is the Liontown high-grade gold deposit that we've discovered. So interesting times and a lot happening in regional Queensland.
Oh, excellent. I think what you guys are doing up there is fantastic, Brett, and not only, as you said, at Ravenswood, but at Thalanga as well.
Yeah, well, look, we're trying to, like I said, the mining industry is a pretty big industry, but there's only a few of us that actually do the digging part of it, and we rely on a lot of other people to do the money part of it and to support us and everything else. But on behalf of the people that actually do the digging, we're ready to have a fair dinkum crack. And look, to be quite honest, being singled out as an industry of significance has greatly assisted us in being able to, to operate during the COVID-19 times. And I think we are, should consider ourselves fortunate that we're in that position where many others haven't been able to operate. We should say, thank you for the support and letting us to continue to operate. And, we take that most seriously too, and make sure that we look after our people and look after the communities around us. We don't want anybody getting sick. We want to keep operating because, that's really, to continue to work, is a privilege at the moment, and, we take it pretty seriously.
Yes, so obviously do quite a bit on your sites for making sure people are screened for COVID and hygiene restrictions, but my experience, most mine sites do that anyway.
Yeah, look, I think the mining industry has been, again, it's great. The collaboration between all mining sites, whether they be, competitors or in different fields. I mean, there's been an enormous amount of sharing of information through, humongous number of, different forums, ideas. And, when one mine's got a great idea, they share it, other people pick it up, the social distancing, the, checking our people's temperatures, additional nursing staff, working out how you manage a mining camp in a village, and catering and all of those things, shift changes, how do you have a shift change when you've got 60 guys standing there and you've got to have 4 metre square around all of them. But I mean, everybody's adapted and everybody's picked up the challenge. And I think in general terms, the mining industry has fared pretty well. I mean, and all of us are very focused about the communities as well, because many of us provide are the primary medical provider in the community, as we are at Ravenswood, for example. I mean, we have the only medical clinic in the township, and we provide nursing services to the community. And again, the community has got behind us and supported us as well. So there's been a huge, a lot of good news stories that have come out of this as well.
Sherene, thanks very much, Brett. Sherene, did you think we should move on to the next one?
Yeah, thank you.
So just the last speaker for today, and then we'll have a bit of a panel chat at the end, was Rob. Rob's is our geologist in the bunch. Company director, explorer, company founder, generally doing everything, including keeping an eye on the market at the moment and trends on the ASX and capital raising. So Rob, take it away.
Well, thank you very much for that introduction. And yeah, this is what old geos do when they get too old to go to the field. They start taking a look at the market. The first graph I've put up there, just sort of what we do here is divide the market into 4 quartiles. This is a resources market from BHP down to penny dreadful. There's about, at the moment, 735 odd ASX resource companies. These are people that are either exploring, digging, or doing something in the way of developing a resource. Now that graph just sort of shows the different levels of return on average between the first quartile, the second quartile, third quartile, and fourth quartile of the market based on market cap size. Now, if you have a look at the green one at the top, and over on the left-hand side, it says June 18, and then it says 55. So what it means is if you bought a share in the average first quartile company 2 years ago, you would have made about, or the the depreciation is around about 55% on average, which is pretty good. And if you go down to the second quartile, which is a red one, you've probably it's breaking about even, but the third and fourth quartile are losing money. So on the average, an investor buying a stock in the third quartile of market cap 2 years ago is probably down about 30% on average, and about 55% in the fourth quartile. Now, what are the quartile breaks at the moment? Typically, the first quartile is a company with a market cap of greater than 50 million. It fluctuates around a little bit week by week. And so they've obviously done very well. And they're basically what conservative investors, the mums and dads, the people outside the industry, should be talking to their investment advisors about. The second group are not too bad. You'll see that graph, the red graph, starts to rise, and this, if you go across to the 12, which is if you bought at the average stock in the second quartile 12 months ago, you're probably up about 25%. The third quartile is raised up again, done well, pretty well in the last 12 months as well, but going back 2 years, not so good. So this is a little bit risky. And the fourth one is extremely risky. The fourth quartile is companies that have typically got market caps of less than $5 million. Next slide, please. So there's actually an impact. If you look at the Appendix 5B reports, now this is 83%, predominantly they're explorers, but we do have, there's still producers in there like Red River and others that are still putting in their 5B reports. And if we look at those, if we look at the first quartile over the last 12 months, on average, they've been able to, if you look at the left-hand column there, they've been able to, they've spent 8.46 million on exploration, administration 2 million, and on then the explorer administration ratio is they're getting about $3.86, if you like, into the ground per dollar in administration. They've been able to raise on average 20 million, and so the capital to raising to explore ratio is 2.36. Going across to the other side, and I have to move the little screen here somewhere, we see a different picture where the average company in the fourth quartile over the last 12 months has spent about 0.64 million, so that's 640,000 on exploration on average. But they spent 470,000 on administration. So it's only $1.36 on exploration for every dollar on administration. That's not too good. It's even worse when you look down at the capital raising when, whilst on the left-hand side, the bigger companies have been able to raise 20 million on average. The one in the fourth quarter has raised 660,000. So they're just raising enough that's maybe paying the exploration, but probably, but not the rate. They're not raising enough to cover both the exploration and administration. So basically, our advice is to a company that's got a market cap of less than 5 million, you need to restart. And there's been some very, very successful examples of that over the last 12 months or 2 years. Some of them that come to mind are Spectrum, that's just been taken over by Ramelius. You know, 2 years ago, that was definitely a fourth quartile company. So it basically needs a project put in. A company with a market cap less than 5 million doesn't have a market friendly or market acceptable project generally. Need to toss it out. Forget about what directors might have old sentiments about certain projects. Geologists are the worst of the lot about hanging on to old projects. Kick it out. Maybe sometimes you've got to change the management and totally restructure the company because otherwise it just doesn't work. Next slide. So if we look at now a graph of exploration expenditure by 5B reporting companies over the last 4 years on a quarterly basis, the graph has been rising steadily. Back in 2016, the average junior, the total ASX of the junior sector or the 5B reporters were spending about 300 million a quarter. by 2019 that had gone up to 450 million, and now it's gone up above that again. It obviously sawtooths. If you look at the dips, they tend to occur generally in the first quarter, which is logical because that's the season. People in Australia are not out in the field. There have been some exceptions to that. But basically, exploration has been increasing over the last 4 years. Next slide, please. On the left-hand side, we have a graph of the average spend per junior. So that has actually risen as well because there's actually been a significant decrease of it's more than 10%, I think, of the number of ASX resource companies over the last 4 years. But so the actual spend per junior has gone up from about $450,000 to $500,000 a year, a quarter, up to about $700,000. Of course, this figure gets certainly pushed up by the bigger companies, but it shows that basically companies are spending a lot more, not quite double, but nearly double over about 4 years. If we look at the right-hand curve now, in this publication that I bring out every day, that some of the big companies around Australia and around the world now say it's the first email they open in the morning, which is a great thing to see. We have section E, which is where we put all the drilling results announcements. So when a company has a drilling, that's with their assays and everything in there. If we look at the amount being spent per drilling announcement, it has gone up from about a ratio of about 1 there to about 1.4 over the last 4 years. So, 40% increase on what's spending. And that's logical because basically what's happening is that companies are looking more undercover, they're drilling deeper, drilling costs are going up, costs of exploration are going up, and that's only going to increase. We're going to have to go deeper. Looking at the share price movements by exploration spend, the left-hand graph shows the average share price in cents over the last 12 months in the red one at the top is for people companies spending more than $3 million. The green one is between 1 and 3, and the other two, the black dotted one is half to $1 million in the year, and the yellow one is 0.2 to 0.5. Now you see that the yellow and the black, they're not, they're down there together, they're not going anywhere. But if you see the green and the red, basically, particularly the green, has had a big rise. So basically, our view is that companies need to be looking at spending, on average, $1 million or more a year if they're going to really be able to do enough work that's going to keep the market interest, because the professionals here will be getting out an announcement every 3 to 4 weeks. Otherwise, the market starts to lose interest in them. On the right-hand side, the graph is normalised to 100% on the right-hand side. So the yellow graph at 120, which is the smaller guys, it means that the exploration spend has dropped 20%. The share price has dropped 20% for the people that are spending less than $500,000 over the year. Whereas if the red one, which is on 80% on the left-hand side of its graph, it's gone up 20% over the year. The dip in the middle towards March there, of course, is the COVID situation. The next slide, please. Just looking at the average share price changes by commodity, zinc's had a disastrous year. The average zinc explorer has gone down quite considerably. If we look to the right-hand side, the commodities on average that have risen are gold up from 6 normalised to 100% now. The share price, average share price, was 60% of that a year ago, so that's gone up about 40%. Iron ore have done well. Nickel dipped a little bit and then has come up again, and copper unfortunately has moved down. So that's what the metals are doing. Getting a lot of interest right now in gold and also in nickel, particularly magmatic nickel deposits, and in copper gold porphyries. Next slide.
Rob, we're going to have to soon wrap you up, so hopefully...
Righto, yeah, well, I'll push through. Battery minerals have been a disaster, and the reason for that has been the hockey stick projections that people were using. Next slide. And energy, of course, has struggled over the year because of falling prices, particularly in oil and gas and coal. Thanks very much. Move on. Okay,
Thanks very much, Rob.
You want me to finish up now?
Yep.
Yeah.
Yep.
All right, that'll do then.
We have a question for you though, Rob, something to clarify. What's the difference between the quartile categories in terms of market cap, please?
Sorry, I did say that. I'll say it again. Roughly at the moment, and it varies from week to week because we take equal number of companies, generally the first quartile companies have a market cap of more than 50 million. The second market cap generally from about 15 to 16 million to 50 million. The third quartile from about 5 million to 16 million, and then the small companies are under 5 million. That's the fourth quartile.
Okay. And a comment from Murray Hutton to everyone was exploration expenditure in dollars does not necessarily equate to money well spent.
Absolutely agree with you, Murray.
Excellent.
That's why you need geologists.
Yeah.
Look, just to finish off the panel for everyone, and I'm just aware of the time, Sherene.
Yes.
But we have one particular one at the bottom, which I thought came in earlier, which was interesting. If mineral resources have intrinsic value before extracting them, and a decision to go ahead with mining implies that can be extracted at a profit, even factoring in prices, volatilities and other things like COVID, then why are stakeholders, more importantly investors in the mining industry, still losing money? Well, my comment to that would be they're not all losing money, but...
Mark, Rob, Brett?
Timing's very important in making any investment.
Yeah, I think I'd be inclined to agree with you that, not everybody's losing money. It's a cyclic business.
I think, Brett, particularly your position, because you have both private investors through people like EMR, and then you're also the chairman of a public company. I mean, do they view the market differently?
Well, there's, there are fundamentally differences, but I mean, ultimately, it really comes down to the quality of the asset, doesn't it? And the belief, the belief in actually, in the intrinsic value in the ground is not worth anything if you don't believe you can get it out. And so you have to have that belief, and I mean that's really the that's the ultimate goal that we're all looking for. We're trying to to find something or identify something that's got value that's not fully realised yet. I mean, and that's really the that's really the great opportunity, and that's really what it's all about, is finding value where others before haven't been able to, or having some technology that can unlock it, or having a different way of looking at it, or that's mining and exploration in particular is a particularly risky business. It's a higher risk, higher reward game. There's some science associated with it, and you have to make your call based on the information that you got. And if you want to wait until something's completely JORC compliant before you're going to invest in it, that's fine. But it may not be the way to get maximum value for yourself either.
Mark, do you have a comment on this as well?
I think it's already been very well said. The only other comment I'll say is I guess different owners or different management teams look at projects in different ways. And obviously look at developing a resource or in terms of different mine plans and cost structures as well.
Okay, excellent. We might wrap it up there if that's okay, gents, of the speaker panel. Andrew, do you have any final comments?
I'd just like to thank everybody for being involved at 5 o'clock in the afternoon and having a cup of tea with us.
Excellent. Yes, thank you so much, Andrew and the Brisbane Mining Club, for helping us put this together. Aaron and Mark, thank you for your insights. I think, like I said, we've had a number of new attendees to today's episode, definitely wanting to see both the financial and the legal elements. Lots of work obviously going into what you guys do. Brett doesn't obviously have an easy job managing the operations and the sites, but he always gives us his time. So thank you so much, Brett, for your support and good luck with the project. And Rob, sorry to cut you off, but I think we could probably sit there and listen to a lot of your insights. Hence why people read your stuff daily. So keep pressing on with that. So thank you for that. And obviously, thank you to everyone for joining us. We always appreciate seeing all your faces again at 5 o'clock. And yeah, look forward to seeing you guys in a fortnight for the next episode of Minds and Money 5 at 5. And again, if you didn't catch any sessions from the Minds and Money APAC online event, you can do so online, or otherwise take part in the EMEA, which is, I can't even remember what EMEA stands for. It's I'm brain dead at the moment, but Europe, Middle East and America's session, which takes place next week. So thank you to everyone, especially the Brisbane Mining Club and the Melbourne Mining Club.
And
thank
just
you.
to finish off as well, Sherene, before we go, looks as though Mining Club will be having our first face-to-face meeting in August, subject to Victoria not going downhill too fast in the meantime.
Oh,
So,
well, yeah, good luck to
just
everyone.
let everybody know.
Wherever in the world you are, it's looking like some people are talking to us in the chat function right now from Auckland. I know that someone joined in from South Africa. I think we've got someone from Scotland, and someone's there from the UK, which is 34 degrees over there. We're freezing over here in Sydney. I don't know Brisbane, but yeah, thank
Brisbane's
you.
worse.
So thanks very much for joining us. And Richard Johnson, we saw your wife saying hi to us just now, so hi back to her as well. Thank you.
Thank you
very much.
Thanks, guys.
Thanks.
Yeah, thanks very much, Andrew.